Well, thank you for that, Shireen. I'd now like to invite on stage our keynote speaker for the evening. Everyone's excited to listen to him speak, a man who's been a keen observer of the Indian economy for many years now, and he's been investing in global emerging markets for over 40 years and has won not only multiple awards but multiple nicknames as well. He's known to many as the father of the emerging market funds, or to some as the Pied Piper of emerging markets. He's here to share his views on the India story. Ladies and gentlemen, please welcome the Executive Chairman, Templeton Emerging Markets Group, Franklin Templeton Investments, Dr. Mark Mobius.
Thank you very much. Say, with all these beautiful women, what do you need me here for? I mean, they're smart, they're beautiful. I don't know whether I should be here at all. But let me give you a quick overview of what I feel. And by the way, today I threw together a few slides which hopefully will give you some insight into some of our thinking, which may not be in the right direction, but at least it'll give you some feel for what I and some members of our team are talking about on the emerging markets outlook. First, we have to talk about performance. And I must admit, it's been very disappointing. If you look at emerging markets, this, by the way, is the MSCI index, and you'll see that in the last 3 years, emerging markets have underperformed the developed markets. The good news is that out of the last 12 years, 7 years have been outperformers. So there is hope. And usually when you have a long string of losses, things turn out better, we hope. But we also know that there are significant performance differences. If you look at China and India, they've done, in the last 5 years, a lot better than Russia and Brazil. Now, of course, when we look at something like this, we think, hey, maybe it's time to get into Brazil. So there will be chances for outperformance as we go forward. But so far, it's really China and India that have been the winners of this race. Currencies, of course, have played a very important role. And of course, with the Fed threatening to rise interest rates, this has hurt currencies around the world. And you can see here, year to date, ending October, Brazil, of course, has had the big devaluation. But India has been pretty good, not bad, in terms of the currency. And as I'll show you later, there's a good reason for that. If you look at the 5-year period, again, of course, China's had a pretty much controlled currency. India has come down, but not as much as Russia and Brazil. We believe going forward you're going to see continued growth in terms of GDP in these countries. If you look at the history since '05, you'll see that the average has been about 5.75%. Recently, we've come down on the average because of what's happened in Brazil and Russia. But still, for this year, we're looking at about 4% growth, which is double that of the developed countries. And next year, we believe it'll be more than that. So the growth is still there. And if you compare China and India, you'll see that 2014, more or less equal in terms of growth rate. And going forward, 15 and 16, we believe that India will outpace China, because China now is a huge economy, and it's going to be very, very difficult for them to match the growth. However, as I like to point out to people, China is huge. And if you look at the growth from 2013 to 2014 in dollar terms, the amount was about 866 billion growth in China's economy, which is more than the total GDP of Turkey, Saudi Arabia, and a bunch of other countries. So this is a great opportunity for all of us, including companies in India, to grow in China as well. And of course, going forward, China is launching a huge project, a large-scale cross-border infrastructure, the One Belt, One Road concept that will reach to Europe and tie these countries together. And of course, That means tremendous amount of infrastructure spending. If you look at emerging markets, you'll see that more and more exports are coming from emerging markets. Since 1996, we've gone from about 20% of the world exports to about 41%. You're seeing the same thing for imports, from about 20% to now almost 40%, 39% roughly. And if you look at GDP as a percent of the world, emerging markets are now moving up, continuing to move up, and being about 32% of the total. If you look at the world market capitalization, of course recently with the underperformance, it's been sort of moving sideways, but still we've gone from about 10% of the world to over 30%, and we believe that's going to be coming up again. If you look at foreign reserves, you'll see that emerging markets now have more foreign reserves than the developed countries. Developed countries including the US, Japan, Western Europe, Australia, so forth. So it's come down a little bit recently, but still emerging markets are looking very good in that sense. And if you look at the question of oversupply of property in China, I know a lot of people think of the ghost cities. I just came back just yesterday from a 5-city tour in China, and they continue to build. I mean, you see a lot of buildings have gone up, but they're continuing to build. And the reason, of course, is this. People are living in the cities. They're moving to the cities. You're seeing a tremendous flow of people into the major cities in China. And you can see here, they've got a long way to go to catch up with the US. The future, of course, means the internet, because this is having an incredible impact on emerging markets around the world. There are now over 3 billion internet users on this planet Earth, of the 7 billion people here. And if you can look at smartphone sales, you'll see that in 2008, there were about 100 million smartphones sold, and in 2014, it was almost 1.2 billion smartphones, and it's continuing to go up. And you can see that smartphone sales now represent 70% emerging markets. So this is an incredible change. With that smartphone, and we've seen it here in India, everybody has a smartphone and they're transacting their banking activities on the smartphone. This is an incredible revolution. And if you can look at how smartphones are beginning to replace the PCs, personal computers, you'll see that 2011, that has already taken place. The other good news, of course, is that prices are coming down. The prices of smartphones are coming down. Why? Because DRAM prices are coming down. Flash memory prices are coming down. Solid-state drives are coming down. And if you look at mobile penetration, you'll see China is almost completely penetrated. India will be in the next year or so fully penetrated with mobiles, not necessarily smartphones, but at least mobile phones, and of course smartphones will follow. One of our favorite sectors here in India is the IT services sector, and you can see that IT exports from India have been going up at a very nice pace, and we think that will continue. And if you look at the market share, it's still a relatively small part of the total world, about 3%, and that should go about to 20% going forward as we look at it. Revenue per employee is going up in the Indian smartphone area, and EBIT per employer is also going up. So this is a very exciting area. Now, a lot of people are worrying about liquidity. Is there enough liquidity to feed the market? And my answer is a resounding yes, because you could never get off the number of IPOs that are now taking place, not only here in India, but all over the world, without liquidity. And if you look at central bank total assets, you'll see since 2006, there's been almost a steady rise in central bank assets: Japan, Euro area, US, China. And the interesting thing is this, is as these bank assets go up, these are the red bars, the velocity of money has gone down. In other words, the loan-to-deposit ratio of U.S. banks has been going down. They're not lending. They're sitting on these assets. So once this idea begins to break through and the banks have already restructured their balance sheets, you're going to see this money flowing into the markets again. And you're seeing the same phenomenon in Japan, growing central bank assets and lower velocity, and loan-to-deposit ratios going down. You're seeing the same thing in China, lots of assets, but velocity going down, loan-to-deposit ratio going down, and of course recently you've seen a little bit of a pickup, but not much. And the same thing is true of the Eurozone. You've seen an incredible decline in the loan-to-deposit ratios. So we believe a turnaround in this trend could have a tremendous impact on the markets. Now let's talk about reform, because I know here in India everybody's concerned about reform. Everybody was so joyful when Mr. Modi was elected, and we all expected things to happen tomorrow. Of course, things don't happen tomorrow. It'll take years before some of these things pass through. And you can see bills passed annually by the Parliament here in India has gone down. So there's been sort of a little bit of a paralysis. Projects under implementation have grown, but the growth rate has come down, as you can see by that blue line. It's only recently they've begun to come up, and we believe, you know, the glass is half full. The glass is going to be full as we go forward. And the exciting thing for me is the success of this program to get bank accounts and identity cards for the lower income segments of the population. This, I think, is going to be a revolutionary change taking place in India. It won't be noticed, but it will sort of creep up on us, because you can see the accounts with zero balance and the accounts with money in them, the account transfer with their cell phones. In terms of the ease of doing business, India is not as good as China, Turkey, US, so forth. There has to be an improvement there, and I believe some of the Modi reforms will solve that problem. However, despite that, net flows, FDI flows, have been coming up, and that's good news, in anticipation, of course, of the reforms. Now, the problem we have is one of confidence. And by the way, this chart is a very nice way to monitor what is going to happen to the equity market. Because what it does, it shows you the red line is the MSCI index since '06. The blue line is the spread between emerging markets debt and US Treasuries. Of course, if that spread widens, people are not confident, and the stock market goes down. And that's precisely what happened in '08. You can see that. Since that time, the blue line, the spread, has been moving more or less sideways, but recently it's coming up. In other words, people are demanding a little bit of a higher rate for emerging markets debt compared to US Treasuries. And of course, as a result, the equity markets, MSCI, Emerging Markets World Index, has come down. It remains to be seen what happens from here, but I believe that probably we're going to see that blue line coming down. People will get more confident. However, sentiment is very bad. You can see the net percentage of investors over or underweight in emerging markets. Red means underweight, blue means overweight, and you can see that people have been very disappointed and have been underweight. Now, when we see that, we think there's going to be a great potential for a turnaround, and we think that will come as people wake up to the reality of growth in emerging markets. Values are good in emerging markets. You can see the price-earnings ratio for emerging markets is lower than that of developed markets. If you look at the price-to-book value, you see, again, emerging markets are cheaper. And if you look at the future going forward, we believe that it's going to look better than what we see now. You can see over the long term, emerging markets did very well, particularly during the 04 to 14 period. Recently, it's come down to the level of the U.S. market. But if you look at dollar cost averaging returns since the 20-year period, you'll see that emerging markets have done better on the average than the developed countries. And looking at the 20-year period, we believe that India will be doing better than China. I'm just doing a straight line projection based on what the history has been, and we believe that India will grow faster in terms of their market performance. Thank you very much. I have a blog and Twitter if you're interested in learning more about what we're doing, and I'd be happy to take any questions you may have. Thank you very much.